In today's video, we will discuss the hammer candle, which is regarded as a highly significant reversal candlestick pattern in price action trading. Let's dive into the video, but before we begin, if you find something useful, hit the like button, and if you are new, make sure to subscribe and turn on the notification bell so you never miss our latest uploads. I will see you right after the intro and disclaimer. Here the market is in a downtrend, and the price shifts upward, forming a hammer candle at the bottom zone. The body of a hammer candle is always small, while the wick of the candle remains much longer than its body. The longer the wick appears, the stronger the performance of the candle. A hammer candle can form as either red or green. The candle's color holds no significance in this case. Based on price action, sellers gradually lose control of the market as the price declines and they exit their positions. Simultaneously, fresh buyers step in and attempt to push the price higher once again. This is the reason the market transitions from a downtrend to an uptrend at this point. Here, some existing sellers make one last attempt to drag the price lower, while the remaining sellers begin securing profits, which reduces their strength. At the same time, new buyers enter the market, forcing out the leftover sellers and reversing the downtrend. This is how the shift into an uptrend occurs. Now, let us observe some examples on the chart. In the second example, within a bearish trend, two large red candles form on the chart, causing a sharp drop in the market and driving the price lower rapidly. After the price covers a wide gap through these two candles, no additional sellers enter the market, leading to the creation of smaller red candles as the price declines. Here, noticing the decreasing selling pressure, new buyers join the market and push the price upward, forming a hammer candle on the chart. Once again, sellers attempt to push the price back down, but due to growing buying pressure, the price reverses and moves higher. Now let's look at the third example. In this case, the price rises with uptrend momentum while forming a price action structure of higher lows. After some time, however, sellers step in and reverse the price downward, creating a support area near the lower levels of the chart. As soon as the price reaches this support area, the selling pressure eases, and sellers close their trades. They lock in profits while new buyers enter at the same level, ensuring the price maintains its earlier uptrend. You cannot rely solely on a hammer candle in any chart to take a reversal trade. Along with identifying the hammer candle, you must also confirm the support line developed in price action on the chart. In the next example, the price moves upward in the uptrend while still forming higher lows. Once the price makes a new high, existing buyers in the market book their profits, creating a small corrective move in the price. A support line then appears on the chart at the previous high level. When the price touches this support line, new buyers step in again, producing a hammer candle on the chart. Here, the price sustains its uptrend by taking support from both the prior high level and the moving average moving up from below. In this case, the hammer candle serves as a fresh entry opportunity for new buyers. You can initiate a long trade entry here by combining the candlestick pattern with the key level from price action. That's it, traders. Thanks for watching. Every big journey starts with a small step, and today you've taken one more step forward. If this video added value to your journey, give it a like, it truly helps. And if you're new here, subscribe and join a community that's focused on learning, growing, and winning together. Thanks for watching, and I'll see you in the next video.